Last month, we talked about the ongoing world trade situation not showing any sign of a silver lining on the horizon. We're going to follow up on that now with our chief equity strategist and economist, John Blank. John, China's economy and businesses are showing more visible signs of pain from the trade situation, the trade war, as recent data on producer prices and exports has revealed. You were just in Beijing a few days ago. Did you see any physical evidence of this firsthand?
Terry, one of the things I learned in Beijing, particularly from the air, when you get over Beijing, you see that it's a checkerboard. And what you see a lot of pictures of when they talk about overheating or Chinese development, they'll show you a big picture of a block of apartment buildings about 20 stories high, and about 15 of them all looking the same. That's actually true. Anytime they do one thing, they'll do 15 things. 15 of anything. So it's an incredibly big economy. But each square of the land, just think of it as a square rectangle on a checkerboard, is followed by empty fields or empty green space or whatever it is next to it. So it's not dense, and it's very planned, and you see a lot of high-speed rails moving around the country. They're almost brand new. The airport was 10 years old, and there's every highway in and around Beijing was already 8 lanes. You didn't just go from 2 to 4 to 6 to 8 like we do here, where they just flat did it. So I don't think people can appreciate they have plenty of land and open space in Beijing, at least, which is probably representative of a lot of places, to do more development. They are very nationalistic. They basically redevelop squares of land that have been already developed, keeping some of the density and green space around it and moving along. And they have complete eminent domain within the communist system. You can just do stuff. So they don't fight about high-speed rail like we do in this country. It's done. They don't fight about roads. It's done. And so it gets one onto the edge that you just simply should not discount the ability of the central authorities of China to do something about the slow growth. And most of what I've read is it just takes a few months of time, but they are on to this turn. The trade war is not new news. It has been around for a year and a half, and they are fully prepared and probably have things well down the pipeline to stimulate their economy internally.
That said, Treasury Secretary Mnuchin reportedly had a call with his Chinese counterparts last Thursday, July 18th. He says complicated issues still remain in this trade war. Are these issues any different than the ones we've already heard about?
I don't think so, Terry. I mean, at the core of this issue, there's two issues. One, the complicated issue is the intellectual property, which is, I think it's fair to say, copying, counterfeiting, and competition in the Chinese mind are basically the same thing. I was in Mongolia. It was not uncommon for us to see knockoff sweaters of sports brands and various outfits that were completely counterfeit amongst the Mongolian population. Very common practice is to say, hey, it sells, I'll make one too. And they change an E or an A or some apostrophe and get it out there. So this can't happen in an open market economy. But to enforce that, to get intellectual property rights to actually be enforceable on a system like this is very complicated, which is what Mnuchin's driving at. The second part I'll point out to people is the trade balance with the United States and China is driven primarily by the U.S. fiscal deficit position, not by any of these intellectual property issues, and is a separate issue and is going in the wrong direction because of the tax cuts here, and we're not going to fix that. So while I am supportive, and I think Mr. Secretary Mnuchin is leading us in the right direction on intellectual property debates with China that need to be in place, frankly, for the Chinese, too, they can't function with this type of counterfeiting at the level that's going on. But I don't think the Chinese get any blame for the actual size of the trade deficit. That is a domestic U.S. problem, and it will not be fixed without a domestic U.S. solution.
This tariff heat also includes Europe now. What's going on there?
Right, so now we're going to take on particularly autos coming into the United States. It's misunderstood that particularly BMW makes a ton of autos in South Carolina, I believe, in the United States. Not also true for Japan. I think the whole idea is to raise local content requirements in the U.S. plants another few percentage points. I think that's where it will head, and I don't think this administration will actually take Europe on head on. It's the usual good cop, bad cop thing where they send the tough guy and make it look a lot worse to try to get a better deal. That tariff negotiation strategy has not worked anywhere, but it's not going to end anytime soon either.
So what does all this mean then for the overall health of the global economy and global markets?
Well, Terry, here's the thing it's done. It has taken interest rates down a notch everywhere. Even this week, we've gotten more rate cuts out of more central banks. Obviously, the Fed's going to file here in another week or two. So it's the tariffing economies is effectively raising taxes on economies. That's restrictive fiscal policy in macroeconomics. And the way you counteract that is you accommodatively apply monetary policy. So we're going back to juice and liquidity around the world. And that means that we're going to get some stimulus in the global economy from monetary systems here in the next 6 months or so.
And here in the U.S., the second quarter earnings season is well underway. So do you think we're going to see these companies that are exposed to tariffs take a particularly strong hit?
Well, language there, Terry, is important. They're going to take a hit. Whether it's particularly strong is relevant. And I think we're going to get more color and detail about how it's playing out. I mean, again, in terms of when you tariff things, people have the ability to shift somewhat within their supply chains, and they can work around these issues. So what will be interesting is who has the inflexibilities in their supply chains and who doesn't, and that's what we should look for.
There's an earnings decline that's being predicted here, and it's expected to last through Q3. That'll make 3 consecutive quarters of earnings declines. Are we looking at the beginning of an earnings recession?
Well, Terry, I think that the basic answer is profit margins in the United States and global economy peaked in the third quarter of 2018, and I don't think anybody can argue against that, and we're not going to see that end anytime soon. So I think earnings recession is probably the right language, but you got to remember the profit margins were record highs. So it's a pull-off from record highs to highs. It's not meant to be a statement of intent towards the direction of the entire system, but it does mean this is soft earnings stuff, and it's not going away anytime soon. Probably a needed recovery in spending for the labor market, particularly if that's where the margins are getting eroded from.
Top stocks on your radar now include United Health Group, Lockheed Martin, and BHP Billiton. Why?
Yeah, United Health Group, you still got to like the healthcare businesses in the United States. This is sort of the classic Dow component that's most relevant. It just reported earnings did quite well, will do quite well, and it's priced pretty well because of people's worry about a Bernie Sanders candidacy and presidency in a year or so. So ticker UNAs, take a look at it. Lockheed Martin LMT just got a 2-year budget deal passed or agreed to in the U.S. Congress and President. That might mean more defense spending for Lockheed Martin and its other competitors. And then we have BHP Billiton, BHP ticker. And this is a huge iron ore supplier basically in Australia. And again, the problems Vale has had in Brazil, along with the demand picking up from internal infrastructure projects in China to do the domestic stimulus there, putting a high into iron ore prices. Nobody's thinking this is going to end until September, October even. So there's still upside to companies like BHP Billiton.
That's the story on the global markets with Chief Equity Strategist and Economist John Blank. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.